Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and on this episode, we're going to be talking about that 0.25% increase by the Bank of Canada, what it means for you as a Canadian, and what you can do to keep some more money in your pocket. Stay tuned, you don't want to miss this. Earlier this week, the Bank of Canada broke millions of Canadians' hearts by increasing that policy rate by 0.25%. Now, basically, the policy rate has moved from 4.5% up to 4.75%. And this 0.25% jump is also translated to all the major institutions, all the banks, by them increasing their prime lending rate. That prime lending rate has now jumped from 6.70% to 6.95%, which obviously means for Canadians with a variable rate mortgage, adjustable, or home equity line of credit, that those payments are obviously going to increase, especially on those Canadians who have adjustable rate mortgages. Those are the ones that move instantaneously whenever the Bank of Canada makes a monetary policy decision. Now, how does it impact Canadians with trigger rates? Well, as we know, 2/3 of Canadians had potentially already breached their trigger rate in the past in those 8 consecutive increases that we saw up until early 2023. But now with this additional 0.25% increase, the 9th consecutive increase, while many Canadians may have now breached that trigger rate. So it's important to keep a very close eye on your particular mortgage. Have you increased your payments? Have you been contributing by putting lump sums into your mortgage? Or have you locked into a fixed rate mortgage, obviously, or considered restructuring or refinancing that mortgage to simplify your finances? Obviously, there's so many different questions, but it's important to keep a very close eye if you have a trigger rate mortgage. As you know, 1/3 of Canadians who have not breached that trigger rate, they may, but a lot of them are actually prepaying their mortgage down significantly, taking advantage of being able to put a lot of lump sum money towards their principal, which as we start to see this 0.25% bleed through the entire market, well, it's definitely going to have an impact mostly on Canadians with variable rate mortgages. Now, why is this important if you have a fixed rate mortgage? Well, that 0.25% increase that we just saw on Wednesday, the lead up to that particular rate announcement for the Bank of Canada has sent the bond markets higher, market of unpredictability. We've seen those bond yields go from around 2.8% now up to around 3.7%. And that effectively has pushed fixed rate mortgages right across the board up significantly, about 15 to 45 basis points, depending on the particular product, if it's insured, insurable, conventional, obviously depending if it's a stated product, self-employed with an equity lender. I mean, a lot of different things to take into consideration there, but already from just last week, rates have already jumped up. And this is going to impact Canadians who are not only, in a fixed rate mortgage renewing in the next little while, but obviously if interest rates continue to rise at the same pace, well, we'll definitely see many Canadians renewing in the future in a higher interest rate environment, which means that for the Bank of Canada, at least, that it's a good thing because that means there's less money available to Canadians to spend on day-to-day items after they're done servicing their mortgage needs. Now, obviously, the Bank of Canada has made it very clear, not only through the press conference, through forward guidance in the past, but that they are going to do whatever it takes to bring inflation back down to target at 2%. Now, that means whether they have to reduce a recession or they have to increase policy rates to induce a lot of pain, they are serious about that inflation number. And when we start to see things like GDP growth jump, for the first quarter to 3.1%, superseding their expectations, well, obviously you can rest assured that the Bank of Canada will be paying close attention to that, even though a lot of that growth in the economy was driven by what we call human quantitative easing. More population, more people consuming, more people coming to Canada, becoming Canadian citizens. Obviously, this means that we have to take a look at what is happening in the economy here in Canada. Last month, we saw that headline inflation number tick up from 4.3 to 4.4, and we said that this was going to be a major sore spot for the Bank of Canada. And remember, headline inflation was what the Bank of Canada wants to see come down, but they're looking at those core numbers within it. What are those buckets telling us? And the Bank of Canada is saying that energy prices should be coming down as we enter the summer months. Hopefully for many Canadians who are driving to work, who don't have electric vehicles, well, we're going to feel that relief at the pumps, hopefully this summer. Now, obviously, this has a major impact on a lot of other things, right? Because many Canadians, those CPI numbers, the core inflation numbers, what are driving these numbers upwards, the biggest mover, at least in my opinion, is the cost to service mortgages, the cost to service debt, and the cost of rent. These numbers have basically jumped up, causing the inflationary numbers to spike a little bit more. And obviously, this is caused by the Bank of Canada, right? The Bank of Canada's policy or monetary policy is to increase the policy rate to bring down spending, to basically restore the supply and demand balance, help Canadians understand that inflation expectations are going to normalize. We're going to get to that 2% window by 2024, and we're going to see that 3% by the end of the year, and that it's serious. The Bank of Canada, Governor Tiff Macklem, the council is serious about getting it there. And as we've talked about on the channel, a lot of Canadians may have thought that just because the Bank of Canada paused over the last little while that they were not going to increase their policy rate. And the Bank of Canada made it very clear that that was not the case. They were pausing to assess if they've done enough. And obviously, they haven't. This is a 0.25% increase that shows that the Bank of Canada is serious and they haven't done enough. So what does this mean? A lot of economists have predicted that the Bank of Canada wasn't going to act on June. Maybe they were going to jump in July. But obviously they have now, as Bruno Mars would said, left the door open for a move potentially in July. Now, are we going to see a move in July? Obviously, the markets will start to price that in. They're going to start having this conversation. But it's important to understand that the Bank of Canada, the old adage, do not fight the Fed, don't fight the central bank. They will do whatever they need to do, and they've made it clear. So what this means for us as Canadians is obviously what we do next as a whole, as a society. Very challenging because you have many Canadians who are on two different ends of the spectrum. Those who are barely able to make it by day to day, living hand to mouth, and then there's those who have sort of an abundance, the wealth. They are obviously contributing. We're seeing travel uptick even at higher cost. We're seeing more Canadians buying new things, spending in the economy. This is what they're talking about. They're saying that consumer spending is still up. Growth is still up. People are spending money on services. They're spending money on interest goods like housing, right? So we saw this happen in Canada over the last little while as we've seen the average price for a Canadian home come down and then move back up in the last little while. This is something that's very important. Even with interest rates being elevated, more Canadians are entering the housing market. Now, although a lot of these Canadians were put on the sidelines during, the rate hikes of 2022, you can only push Canadians to the sidelines for so long before they have no choice but to continue on their day-to-day lives. And this is something that the Bank of Canada, as I said, is paying close attention to. Are we seeing an overstimulation of, business, of mortgages? Obviously, it's nothing like we saw in the last couple of years. It's, I believe, normal demand, right? These are normal people that are trying to find a home, whether it be to rent, to purchase, to move up, to right size, downsize. These are just normal transactions. Those that are acting in this market, obviously at higher interest rates, either changing their requirements of their home needs. These are the things that are happening for many Canadians who are having families. You can't stop someone from moving. They can push themselves, against the wall for so long before they push back and say, look, we need to get into the housing market. And the Bank of Canada is seeing that. They've pointed out that housing activity has started to begin its ascent upwards. Now, obviously, what this will mean for Canadians in July, what it means for, the economy in the summer months, what's it going to do to the housing market? Obviously, this 0.25% increase is going to push or at least suppress a lot of Canadians who were potentially maybe speculating, right? Anybody who was thinking about getting into the market because, interest rates were coming down, obviously those people are going to get pushed right back to the sidelines. But those Canadians who need to purchase a home have very little option, either rent or they own, they're going to make a choice regardless. And if they have the means to do so, it will end up happening. But as we look at the entire economy, let's take a step back and look outside of Canada. China is expected to slow down. The US is slowing down, but spending is up. Critical issues still unfolding with what happened in the US in March with these regional banks and in Europe with Credit Suisse. We have credit issues. We have so many different components that are playing in to what is happening here in Canada. As you know, if the US sneezes, Canada catches the cold. So this is something that we have to be understanding of. when we move forward. So what can you do best to help yourself, sort of manage these expectations, manage these higher rate environments? Obviously, it's important to have a budget in play. Many Canadians, a lot of Canadians we talk to actually don't have a budget, and understanding what comes in and what goes out each and every month, looking at all the things that they're using, cut back on some of those expenditures that, they don't necessarily need to do. Food is a big component. A lot of Canadians, they find it cheaper to, go out there, and it's a lot easier, I shouldn't say cheaper, but easier to go out there and, order Skip or Uber Eats or whatever the case is. But cooking at home can keep a lot of money in your pocket. A lot of times I know many Canadians, during the height of the pandemic, surplused or stockpiled a lot of food. And, a lot of times you can go through that and actually sort of, burn through some of that old food, keep some more money in your pocket. There are so many different things that you can do, obviously, with your mortgage. If you're in a higher rate environment, maybe you're on a variable rate mortgage, your mortgage rate's well over 6.5%, maybe it's a prime plus, maybe it's a prime minus a very small amount, right? Depending on where that rate is, you may want to consider locking in or maybe refinancing that mortgage into a cheaper rate. Even if it's a small amount, a couple $100 a month can go a long way for a lot of Canadians. I'm not saying for everyone. We're not saying that it's going to make everyone, feel a lot better, but it can definitely keep some more money in your pocket, especially when we consider where interest rates are headed. And obviously there's a lot of stuff to cover. I know that, in future episodes, we're going to be talking a lot more about the fixed and variable component and some of the data that is coming out, obviously, with delinquencies, when it comes to bankruptcies, 90-day arrears with mortgages. A lot of interesting stuff coming up, especially as we wait later this month to get those CPI numbers for the month of May, and obviously what those employment numbers look like for the month of May as well. And one thing, as I said, is we've talked about it on this episode before. Even though we have a very tight labor market, unemployment is very low, the Bank of Canada is still concerned with that, as a lot of this new to Canada individuals, they're coming in, they're able to find jobs, which is great. That's what we want to see. As a Canadian, if you lose your job or you leave your job, you want to be able to find one. But the Bank of Canada doesn't necessarily like that. And just to end off the video, obviously the mantra from the Bank of Canada, if there's anything that you're going to take away from this on what the Bank of Canada is going to do next, economists can predict all they want. At the end of the day, we talked about it just before the rate increase. We said it was about 70 to 75%, upwards trend or basically upward risk on the Bank of Canada increasing in June. Let us know in the comment sections below what you think is going to happen in July. Are we going to see the Bank of Canada jump that rate up in July? And did you expect the Bank of Canada to raise its rate in June? Be honest and let us know in the comment sections below. Once again, don't forget to like, share, and subscribe to the channel. Hit that notification bell and leave those comments below. But until next week, thanks again for watching. Thanks for clicking, and we'll see you again next week.